So last week we talked about, we've been actually for a few weeks now, we've been talking about the stability of companies, right? The management teams of companies and how efficient they are at managing those businesses. And so last week we talked about capital efficiency. How well are they using the capital to produce products and produce projects, produce services, right? We talked, very, quite in depth with that. If you guys haven't seen it, check it out on our YouTube channel there. That measure of stability is it's an inside look at the management team. Well, this week we're going to add a little bit to that. We're not only going to look at how the management team is doing, but we're going to look at the products and the company itself to see how really rock solid they are, how efficient they are. These are the things that we're going to look at. So I have 3 words for fundamental focus this week. And if you don't remember anything else from what I say for the rest of my life, these are 3 words you should live by. Cash is king. Okay. The reason I say that is because we're going to talk about cash operating margins this week. Okay. Cash operating margins is essentially it's how much money, how much cash actually comes in from the running of a business. Okay. So why does that matter? Well, it matters. Cash matters because when things go bad, from maybe a company standpoint or just an economic standpoint or whatever, the companies that tend to do better are the ones that tend to have a lot of cash, right? There are companies in the space that I watch that literally sit on mountains of cash. When I say mountains, I'm talking about tens of billions of dollars, some of them hundreds of billions of dollars, right? Having that cash, in your pocket, so to speak, really gives you a lot of flexibility. It can help companies buy other businesses to reduce competition. It can generate different ideas. It can do so many different things to have that cash. So when you want to look for a really high quality business, that's fundamentally rock solid, that's got stable metrics, all this kind of stuff, you want to be looking at cash. And cash operating margins is one way to really get an idea of what a company's doing, how well they're doing. And if there's another portion to it, I'll get to the end here, but if the trend of their operating margin is starting to slip, it's a little crystal ball, if you will, that trouble could be coming. And again, it's not going to be the only thing you look at, because it never is when it comes to fundamentals, but it will be something that we can take a look at just to make sure that companies are in good health. So how do we come up with this cash operating margin? Okay, let's break it down into something that people can understand. High profit margin companies do very well. Okay, if you sell a product, if you make a product for $100 and you sell it for $200, that's pretty good. If you make a product for $100 and you sell it for $1,000, that's really good. Okay, those companies that do that, the latter of those companies is going to do much better than the other ones that are just kind of skimming by. So that's really what we're looking at, is these high profit margins. So to find this out, I'm going to take us over to Yahoo Finance, one of my favorite. I will throw this in there as well. You'll see that I have Coca-Cola up here. The metrics I'm going to find on Yahoo Finance, which I'll show you, you can also find them on a Form 10-K. So it doesn't matter what company you're looking at. If you just Google Form 10-K, it will give you all of the stuff that I'm about to give you, all the numbers that I'm about to give you. And it's a really good place to find fundamental information on a specific company. So just a little tidbit there to kind of go in and start doing your own research. And as you can see here, I've got the one for Coca-Cola Company. We've been just using this company because it's good. But you can go in and look at filing reports. You can see that there's the 10K annual document here that gives you all sorts of probably more information than you ever want. It's literally 194 pages long. So you kind of got to know what you're looking for, but it is a place to go. This is the investors relation portion of a company, and you will find that for pretty much every company. So that's one place to go. An easier place to go, Yahoo Finance. Just go in, throw yourself in a symbol. I like to use Coca-Cola. And then it gives you all these different tabs here. The one that I'm most interested in is financials here. This is going to give us what we want. So to figure out our cash operating margin, what we're going to do is we're going to take the total from the total cash flow from operating activities and we're going to divide that by revenue. So the way we find that out is we go to the cash flow statement here, okay? And you're going to see here, it says cash flow from operating activities. So we just click that. It gives us these numbers here, okay? 2018 was 7.6 billion, 2019, 10.4. You guys can see the rest of those numbers there. TTM is trailing 12 months, okay? With this here, this is all the cash that comes in from them running their business. By itself, it doesn't mean that much, except that obviously a good business would tend to have this increasing over time. You know, the more cash the business makes over time, the better, right? But we need to compare that to something. So what we're going to do is we're going to say, okay, right now we're just going to use the trailing 12 months because it's easy. We got $12.855 billion in cash. Now we want to say, okay, that's how much cash they got. How much revenue did they take? How much total revenue did they take in? Okay. And so if we look at this here, they took in 37.802 billion in actual revenue. So out of that, if you look at this, okay, if you look at how much they took in, that 12.85 right there, sorry, 12.855 billion, that's about 34%. So you just basically divide this number by the other one, and I think it comes out to 0.34 if my math is correct. Okay, so what that says is every dollar that Coca-Cola brings in, 34 cents of it is cash to them. So the reality is we have a metric, at least one that I look for, world-class companies or companies that are at the top of their game are going to be 20% cash operating margin or higher. In this case, Coca-Cola is at 34%. Pretty stellar. We could look at some other companies. I usually compare these to Pepsi, and we'll go take a look at that one real quick here, just to kind of give you a little bit of a comparison here to see how they're doing. Okay, so you go to the same place, right? So they're 11 billion in cash flow opportunities versus their revenue of 76 billion. So already you can see that Coca-Cola is much more efficient. So this here would be, let me just do some quick math for you here. So 11.1 billion right there divided by 76,876 billion. That's only 14%. So if you look at a cash operating business, Coca-Cola is considerably more efficient than Pepsi. Okay, now this is just one metric, but it's an important one. What that tells us is how this business is running, how the management team is doing with running this business. It tells us a couple other things too. It tells us a couple of intangible things that maybe we don't think about when we think about companies. But a couple other things that we can recognize are brand loyalty is one of them. Okay, brand loyalty, and then the other one, brand loyalty. And the other one is market domination. Okay, so Pepsi and Coke are always battling for market domination. We can kind of look at some metrics to see which one's doing better. But this actually tells us which one is doing better from a cash standpoint, which is very important. But if we think about brand loyalty, everybody knows that we can go out and buy pretty much any product we want. We can get it cheaper. But yet, time and time again, people go out and buy brands, okay? And that brand loyalty tells you a lot about the stability of a company. The brand loyalty for Coca-Cola, as we can see from that cash operating margin, is 34%. That's one of the metrics that's involved in there. Whereas in Pepsi, it's about 14%. So it's a big difference there for those two. Okay. So again, we're just looking at this to see, are they making a lot of cash off the operations of the business? And again, this comes down to management team. It comes down to product. It starts to get into those deeper levels of actual products and services that companies provide. And you could do this with car companies. You could do this with anything, right? But the reality is you want to look at this, and the highest profit margin businesses tend to do better. Now, there's two other things that we need to think about here, and it's two things that we want to see trending, okay? So if we go back to Coca-Cola real quickly here, there's two things that should be trending, and I think this is intuitive, but I just want to make the point about it anyway. If we go back to those cash flows, as I talked about, okay, we want to see these cash flows going up ideally, Okay, so I made 7.6, 10.4, dropped off a little bit in 2020, but the last trailing month is trailing 12 months is considerably higher than this year. We want to see this trending in the right direction. The other thing that we want to see trending in the right direction is the ratio, the cash operating margin. We want to see that increasing. So what I did was I took that 12,855, I divided it by the revenue here, which in this case was 37. Well, now what I want to do is I want to divide the 2020 number. So let's see, let's get that number up there. So 9.844, and I want to divide that by this number here, this 33 million, and that comes out to 0.27. Okay, so in 2020, their operating margin was 27%. Now for the last trailing 12 months, it's 34%. Ideally, we want to see that ratio going up. Now, will it go up forever? No, no one's ever going to get to 100%. But ideally, if we can see that going forward, going up, that's a good sign. If we see that starting to fall off, not just a one-off or two-off, but 2 or 3, 4 years in a row, that could signal that they're having problems creating cash from their business model. That could be a management inefficiency. That could be a product problem. Okay. And this is where you could start to use those other metrics that we talked about, capital efficiency, this kind of metric, and a few others that we're going to talk about in the future. We can put all of these things together to get a real clear picture of the inner workings of a company. And that, at the end of the day, is what fundamentals is all about. Let's look under the hood. Let's see what they got and see if it works for us going forward. So that's our fundamental focus for today. Cash operating margins. And remember, cash is king.